Hello, everyone, and welcome to another episode of Money Matters, the show where we explore the fascinating world of money and finance. In today's video, we're going to talk about the psychology of money and how it affects our decisions and behaviors. This is a very important topic because money is not just a physical object or a number on a screen. It's also a psychological phenomenon that shapes our lives in many ways. So, without further ado, let's dive into the 18 lessons about money that you need to know. Lesson 1: Money's true value. The first lesson is that money is a tool, not an end. Money has no intrinsic value. It only has value because we agree to use it as a medium of exchange for goods and services. The true value of money lies in what you can do with it, not how much you have of it. Therefore, you should always think about how you can use your money to achieve your goals and improve your well-being, rather than just accumulating it for its own sake. Lesson 2: Time value of money. The second lesson is that today's dollar is worth more than tomorrow's. This is because money has a time value, which means that it can earn interest or grow in value over time. The longer you hold on to your money, the less purchasing power it will have in the future, due to inflation and other factors. Therefore, you should always consider the opportunity cost of holding or spending your money and invest it wisely to maximize its future value. Lesson 3: Compound interest. The third lesson is the power of compound interest. Compound interest is when you earn interest on your initial investment, plus the interest that you have already earned. This creates an exponential growth effect that can make your money grow faster and faster over time. The key factors that affect compound interest are time, frequency of compounding, and reinvesting interest. The longer you invest your money, the more frequently you compound it, and the more interest you reinvest, the more money you will have in the end. Lesson 4: Emotional investing. The fourth lesson is to avoid emotional investing. Emotional investing is when you let your emotions influence your investment decisions, rather than following a rational strategy. Emotions such as fear, greed, regret, or excitement can lead you to make impulsive or irrational choices that can harm your financial performance. Therefore, you should always have a clear plan and stick to it, regardless of how the market or your emotions fluctuate. Lesson 5: Frugality and savings. The fifth lesson is to live below your means for wealth. Frugality is the practice of spending less than you earn and saving the difference for future use. Savings are the foundation of your financial security and freedom, as they allow you to build an emergency fund, pay off debt, invest for growth, and achieve your financial goals. Therefore, you should always aim to save at least 10% of your income every month and increase this percentage as much as possible. Lesson 6: Diversification. The sixth lesson is the importance of diversification. Diversification is the practice of spreading your investments across different asset classes, sectors, regions, and strategies. Diversification reduces your risk by minimizing the impact of any single investment on your overall portfolio performance. Diversification also increases your potential returns by exposing you to different sources of growth and income. Therefore, you should always have a balanced portfolio that reflects your risk tolerance and return objectives. Lesson 7: Inflation. The seventh lesson is the eroding power of inflation. Inflation is the general increase in prices over time, which decreases the purchasing power of money. Inflation reduces the real value of your income and savings, as well as the real returns on your investments. Therefore, you should always factor in inflation when making financial decisions and seek investments that can outpace inflation in the long run. Lesson 8: The role of debt. The eighth lesson is understanding debt's dual nature. Debt can be both useful and destructive, depending on how you use it. Debt can be useful when it helps you acquire assets that appreciate in value or generate income over time, such as a home or a business. Debt can also be useful when it helps you leverage your capital and increase your returns on investment. However, debt can be destructive when it exceeds your ability to repay it, or when it finances consumption or depreciating assets that do not add value to your net worth. Therefore, you should always manage debt responsibly and use it only for productive purposes. Lesson 9: Behavioral biases. The ninth lesson is to be aware of behavioral biases in money decisions. Behavioral biases are mental shortcuts or errors that affect our judgment and decision-making processes. Behavioral biases can lead us to make suboptimal or irrational choices that go against our best interests. Some common behavioral biases that affect money decisions are confirmation bias, the tendency to seek, interpret, and remember information that confirms our existing beliefs or opinions, and ignore or reject information that contradicts them. Loss aversion. the tendency to prefer avoiding losses over acquiring equivalent gains, and to feel more pain from losing than pleasure from winning. Anchoring, the tendency to rely too much on the first piece of information we receive, and to adjust our subsequent judgments or expectations based on that initial anchor. Herd mentality, the tendency to follow the actions or opinions of others, especially in situations of uncertainty or social pressure. Overconfidence, the tendency to overestimate our own abilities, knowledge, or skills, and to underestimate the risks or difficulties involved in a task or decision. Therefore, you should always be mindful of your own cognitive biases and try to overcome them with logic, evidence, and feedback. Lesson 10. Delayed gratification. The 10th lesson is the value of delayed gratification. Delayed gratification is the ability to resist the temptation of an immediate reward and wait for a later reward. Delayed gratification can lead to better financial outcomes, as it allows you to save more, invest more, and spend less on unnecessary or impulsive purchases. Delayed gratification also improves your self-control, discipline, and patience, which are essential skills for achieving any goal. Therefore, you should always practice delaying gratification and focus on your long-term vision rather than your short-term desires. Lesson 11. Opportunity cost. The 11th lesson is the concept of opportunity cost in financial decisions. Opportunity cost is the value of the next best alternative that you give up when you make a choice. Every choice involves a trade-off, as you can only use your money for one thing at a time. Therefore, you should always consider the opportunity cost of your decisions and compare the benefits and costs of different options. Lesson 12. Financial education. The 12th lesson is the importance of financial education. Financial education is the process of acquiring knowledge and skills about money and finance. Financial education pays off in the long run, as it helps you make better financial decisions, avoid common mistakes, and achieve your financial goals. Therefore, you should always seek to learn more about money and finance from reliable sources such as books, podcasts, courses, mentors, or experts. Lesson 13. Liquidity and accessibility. The 13th lesson is the significance of liquid assets. Liquid assets are assets that can be easily converted into cash without losing much value or incurring much cost. Liquid assets are important for your financial security and flexibility, as they allow you to access your money quickly and easily in case of emergencies or opportunities. Therefore, you should always have some liquid assets in your portfolio, such as cash, savings accounts, money market funds, or short-term bonds. Lesson 14. The importance of planning. The 14th lesson is the concept of planning in financial decisions. Planning is the process of setting clear goals and strategies for achieving them. Planning is essential for your financial progress, as it helps you define your vision, prioritize your actions, allocate your resources, measure your results, and adjust your course. Therefore, you should always have a plan for your money and follow it consistently. Lesson 15. Sunk cost fallacy. The 15th lesson is the idea of the sunk cost fallacy. The sunk cost fallacy is the tendency to continue investing in something that has already cost us money or time, even if it is not worth it anymore. The sunk cost fallacy can lead us to waste more money or time on something that does not bring us any benefit or satisfaction. Therefore, you should always ignore sunk costs and focus on future costs and benefits when making financial decisions. Lesson 16. Minnies neutrality. The 16th lesson is the concept of Minnies neutrality. Money's neutrality means that money itself is neither good nor bad. It is only a tool that can be used for good or evil purposes. Money's morality is derived from how we use it and what we do with it. Therefore, you should always use your money ethically and responsibly, and align it with your values and principles. Lesson 17. Understanding wealth's purpose. The 17th lesson is seeing money as a facilitator. Money is not an end in itself. It is only a means to an end. Money's purpose is to facilitate our lives and help us achieve our goals and dreams. Money can buy us many things, but it cannot buy us happiness or fulfillment. Therefore, you should always understand why you want money and what you want to do with it. Lesson 18. Effects of price increases. The 18th and final lesson is being aware of money's changing purchasing power. Money's purchasing power is the amount of goods or services that a unit of money can buy at a given time. Money's purchasing power changes over time due to various factors such as inflation, supply and demand, taxes, and exchange rates. Therefore, you should always be aware of how much your money can buy in different situations and adjust your spending and saving habits accordingly. And that's it for today's video. I hope you enjoyed learning about the psychology of money and the 18 lessons that can help you improve your financial well-being. If you liked this video, please give it a thumbs up, share it with your friends, and subscribe to my channel for more videos like this. And don't forget to leave a comment below and let me know what you think about these lessons or any other money-related topics that you want me to cover in the future. Thank you for watching, and I'll see you in the next one. Bye.